Do you know why, when you just bought a stock, its price suddenly drops? Or why good news about a company doesn't make the stock price rise as you expected? The truth that 99% of retail investors don't know is that 40% of total stock trading volume worldwide doesn't happen on the public exchanges you see. They're trading in a parallel world, a financial black hole they call dark pools. Listen, today I'm going to expose how this system has been designed to suck money from the pockets of retail investors like us. You think you're investing fairly in the market? That's an illusion. The story begins in 2008 when the global financial crisis exploded. While millions of people lost their homes and jobs, a group of people made billions of dollars from this crisis. They not only knew what would happen beforehand, but also had the tools to maximize that information. One of their most important tools is dark pools. Imagine you're shopping at a market. The public market is where everyone can see the prices, who's buying, who's selling. But dark pools are like a black market where large trades happen in the shadows. No one knows who's buying or selling what at what price. Dark pools, also called dark pools, are private trading venues where large investors can buy and sell stocks without revealing their identity, volume, or trading price until the transaction is complete. Sounds harmless, right? Wrong. This is how the financial system has created a two-tier market. Tier 1 is the public market where you and I trade, transparent but manipulated. Tier 2 is dark pools, where the real sharks trade, hiding and controlling prices. Who gets to participate in dark pools? Here's the list of aristocrats in the financial market. Large investment funds like BlackRock managing over $10 trillion, Vanguard managing over $8 trillion, State Street managing over $4 trillion. Investment banks like Goldman Sachs, JP Morgan Chase, Morgan Stanley, Bank of America, hedge funds like Bridgewater Associates, Renaissance Technologies, Citadel, and high-frequency trading companies like Virtu Financial, Citadel Securities, Jump Trading. Do you see your name on this list? Of course not. And that's the problem. To participate in dark pools, you need minimum capital of hundreds of millions of dollars, direct connections with prime brokers, advanced trading technology, and special relationships with dark pool operators. In other words, only for the ultra-rich. They'll tell you they need dark pools to avoid market impact when trading large volumes. Sounds reasonable? Let me explain the truth behind this justification. When a large fund wants to sell 10 million Apple shares on the public market, this information will cause Apple's price to drop immediately. Other investors will see the large selling pressure and they'll sell too. So they use dark pools to hide this trade. But this is the problem. While they're secretly selling in dark pool at higher prices, on the public market where you're trading, the stock price hasn't reflected reality yet. You're buying at a fake price, not the real price. How do dark pools work? Instead of placing one order to sell 10 million shares, the system automatically splits it into thousands of small orders. 1,000 shares at 9:15 a.m., 1,500 shares at 9:47 a.m., 800 shares at 9:23 a.m., and so on. These orders are matched with each other in dark pool without anyone knowing. Fund A wants to sell 1 million Microsoft shares. Fund B wants to buy 1 million Microsoft shares. They trade with each other at an agreed price, usually the average of bid-ask prices on the public market. Only after the transaction is complete is the information published. But by then, it's too late. The market has already been affected. How smart are these algorithms? They can analyze millions of data points in 1 millisecond, predict retail investor behavior, automatically adjust trading strategies, smell large orders about to be placed. Large funds pay millions of dollars each year to place their servers right next to dark pool servers. Why? To gain time advantage measured in microseconds. While your order has to go from computer, internet, broker, exchange, taking about 50 to 100 milliseconds, their order only takes 0.001 milliseconds to execute. They use artificial intelligence to recognize trading patterns of retail investors, predict short-term price movements, optimize trading timing, avoid traps from other algorithms. Why are retail investors always at a disadvantage? Imagine you're playing poker, but your opponent can see your cards. That's exactly the situation of retail investors in the stock market. What you see is bid price $100.50, Ask price 152, volume 1 1,500 shares. What they see is 15 dark pools with buy orders totaling 500,000 shares at $100.45, 23 dark pools with sell orders totaling 800,000 shares at $155. Real money flow going into or out of the stock. Large orders about to be executed in the next 5 to 10 minutes. The result is you're making decisions based on 30% of information while they have 100% of information. Front running is one of the dirtiest tactics dark pool operators can use. Specific example, you place an order to buy 1,000 Tesla shares at $250. Dark pool receives this information before executing your order. They quickly buy Tesla at $249.90, then sell it back to you at $250s. They make 10 times 1,000 equals $100 from your trade. Multiply by millions of trades each day. The money they steal from retail investors amounts to billions of dollars each year. Price discovery distortion is another serious problem. Prices in the stock market are formed through the price discovery process. Supply and demand interact to create fair prices. But dark pools have destroyed this mechanism. Case 1. Artificially high prices. Dark pool has 2 million Apple shares being sold at $180. The public market doesn't know this information. The price on public exchange is still $185. You buy at $185, while the real price is only $180. Case 2. Artificially low prices. Dark pool has 3 million Google shares being bought at $2,800. The public market doesn't know this information. The price on public exchange is $2,750. You sell at $2,750, while the real price is $2,800. Latency arbitrage, or profit from delay, is how they turn delay into money. When there's important news about a company, for example, Apple reports earnings beating estimates, this information is processed in order. First 0.001 seconds, HFT algorithms and dark pools receive it. 0.1 seconds later, professional traders know. 1 to 2 seconds later, retail trading platforms update. 5 to 10 seconds later, you read the news. In those 5 to 10 seconds, they've already bought millions of Apple shares at old prices, pushed the price to new levels, sold back to late investors, including you. The result is you always buy high and sell low. How dark pools increase your trading costs through spread widening. Before dark pools, bid $100, ask $100 twos, spread 2-2. After dark pools suck liquidity, bid 99.98s, ask $100 fours, spread $6. This means your trading costs triple just because liquidity is moved to dark pools. Have you ever wondered why sometimes stock prices suddenly pierce through a strong support level for no clear reason? That's because of iceberg orders, huge orders hidden below the surface. Real example, on the public exchange, you see buy order at $50 with 10,000 shares, buy order at $49 with 15,000 shares, buy order at $48 with 20,000 shares. You think the support at $48 is very strong with 20,000 shares, but in reality, dark pools have a sell order at 48.01 cents with 2 million hidden shares. When price touches 48.01, 2 million shares suddenly appear and push the price down to $45 in seconds. You get stopped out at $47, while they accumulate at $45. Momentum ignition or momentum initiation is a sophisticated tactic to manipulate investor psychology. Step 1. Create fake momentum by placing a series of small buy orders on the public market. Price starts rising from $100 to $101. Technical indicators signal buy signal. Step 2. Attract the crowd. Retail investors see momentum and jump in to buy. Volume increases. Price continues to $102, $103. Step 3. Execute the real plan. In dark pool, they secretly sell millions of shares at $102 to $103 levels. After selling is complete, they withdraw small buy orders from public market. Step 4. Harvest. Price collapses to 98, 95, 92. Retail investors panic, sell at losses. They accumulate again at low prices. Quote stuffing or information noise is how they create fog to hide intentions. In 1 second, they can place 10,000 buy orders, cancel 9,999 orders, leave only one real order. The purpose is to make other investors' algorithms confused and make wrong decisions. For you, level 2 data is noisy. You can't properly analyze real buying selling pressure. Fragmented liquidity is also a big problem. Before dark pools, 100% of trading happened on public exchanges. You could see all real liquidity, accurate price discovery. Currently with dark pools, 40% trading in dark pools, invisible, 35% on main public exchanges, 25% on other alternative trading systems. The result is you only see 35% of the real picture. How can you make right decisions with 65% missing information? Predatory algorithms programmed to hunt retail investors come in various types. Stop-loss hunter scans all stop-loss orders in the area, pushes price down to exactly trigger stop-loss levels, accumulates shares cheaply from stop-loss orders. Breakout faker creates fake breakouts to attract momentum traders, waits for them to enter orders, immediately reverses to trap them. Support resistance breaker identifies important support resistance levels, uses capital power to pierce through these levels, creates panic selling or buying. Instead of competing, large dark pools have formed a network, sharing information about order flows, coordinating to maximize profit, together hunting retail investors. For example, Dark Pool A discovers a retail investor placing large Tesla buy order, notifies Dark Pool B, C, D all buy Tesla first, then sell back at higher prices. Many investors think using TWAP orders will get fair prices. Wrong. How they game TWAP. Algorithms recognize your TWAP order, predict timing and volume of each slice, front-run each slice with small volume, push price up before your slice executes. Result, your TWAP price is 0.5 to 1% higher than real price. VWAP manipulation is even more sophisticated with VWAP pinning tactics. Monitor VWAP benchmarks of large funds, manipulate volume patterns so VWAP leans toward favorable direction. For example, if they want low VWAP, they'll pump volume heavily when price is low, reduce volume when price is high. Result, pension funds, mutual funds representing people's money lose billions of dollars each year. Don't naively think this is a free market. The Big Four control over 70% of dark pool volume. Citadel Securities processes 40% of retail investor order flow in the U.S., owned by Ken Griffin, billionaire who made $68 billion in 2023, can see your order before it reaches market. Virtu Financial is the second largest market maker, profitable for 1,238 consecutive days. Lost money only one single day, 99.92% win rate. Is this miraculous number coincidental? Two Sigma Securities uses AI and machine learning. Founders are former D.E. Shaw, Jeff Bezos' hedge fund. Jane Street specializes in ETF arbitrage, profits from inefficiency between ETFs and underlying assets. Common point, all have close relationships with Wall Street banks and the Fed. Payment for order flow is how they turn your trading information into money. Robinhood, TD Ameritrade, E-Trade, Webull all sell your order flow to Citadel Securities for 0.02 to 0.005 per share. Virtu Financial for 0.03 to 0.007 per share. Two Sigma for 0.4 to 0.008 per share. Specific calculation. Robinhood has 23 million users. Average each user trades 50 times per month. Average 100 shares per order. PFOF revenue is 23 million times 50 times 100 times side 5 equals $575 million per month. What does this mean? Your free trading app isn't free at all. You are the product being sold. Why can't the SEC stop dark pools? Revolving door phenomenon. Former SEC Chairman Jay Clayton to Simpson Thacker as lawyer for Goldman Sachs. Former SEC Chairman Mary Shapiro to Promontory Financial advising large banks. Former SEC Chairman Arthur Levitt to Goldman Sachs Bank. This pattern repeats forever. Work for Wall Street, get appointed to SEC, create light touch regulation with Wall Street, return to Wall Street with higher position. Result, dark pool regulation is just theater to pacify public opinion. Economics professors will tell you the market is efficient. Bullshit. Efficient market hypothesis is only true if all information is public. Everyone has equal access to information. No insider trading, no market manipulation. Reality with dark pools, 40% of information is hidden. Insider information traded legally through dark pools. Market manipulation happens 24/7. Massive information asymmetry. Conclusion. The stock market isn't an efficient market, but a rigged casino. Now you understand the stock market isn't a place where you invest, but where you gamble in a rigged casino. Dark pools aren't tools to improve the market as they propagandize. They're automatic ATM machines designed to transfer money from retail investors' pockets to giant financial corporations' pockets. This system is built on a simple principle: information is power, and power makes money. Undeniable numbers. Retail investors lose an average of 1.5 to 3% each year just from dark pool manipulation. Institutional investors earn an extra 2 to 5% alpha from exploiting retail flow. Total damage to retail investors is $150 to $300 billion per year globally. Don't naively think this is natural market evolution. 1989, Black Monday. Market collapsed 22% in one day. Official reason: program trading caused domino effect. Solution: create circuit breakers and alternative trading venues. 2001, dot-com bubble burst. Official reason: market needs more liquidity. Solution: expand dark pool regulations. 2008, financial crisis. Official reason: need market stability. Solution: allow dark pools to operate more broadly. See the pattern? Each crisis is used to expand financial corporations' power, not to protect retail investors. How to protect yourself? First, understand the game. Don't fight the system. Learn to live with it. Accept that you're always at a disadvantage. Don't try to be smarter than algorithms. Focus on long-term investing instead of short-term trading. Second, choose the right broker and timing. Avoid brokers that sell order flow like Robinhood, TD Ameritrade, E-Trade, Webull. Use brokers with direct market access like Interactive Brokers, Fidelity Pro, Charles Schwab Pro. For trading timing, avoid market open from 9:30 to 10 a.m. because volume manipulation is highest. Avoid market close from 3:30 to 4 p.m. because window dressing occurs. Trade during midday from 11 a.m. to 2 p.m. when manipulation is less. Third, use smart limit orders. Never use market orders because you'll get maximum slippage. Limit order tactics: place price in the middle of bid-ask spread, split large orders into multiple parts, use hidden quantity if broker supports it, avoid round numbers like $50, $100 because that's where algorithms concentrate. Fourth, smart diversification. Don't just diversify assets, diversify strategies too. Asset class diversification: 40% blue chip stocks, less manipulated, 30% index funds, ETFs, hard to manipulate entire index, 20% alternative investments like real estate, commodities, crypto, 10% cash bonds as defensive position. Geographic diversification: 60% developed markets like US, EU, Japan, 30% in markets like China, India, Southeast Asia, 10% frontier markets like Africa, Latin America. Time diversification: dollar cost averaging over 12 to 24 months. Avoid lump sum investment. Rebalance quarterly, not daily. Fifth is technology defense: using technology to level the playing field. Level 2 data services like NASDAQ TotalView, YS OpenBook, CBO BZX Book. Alternative data sources like satellite imagery for retail foot traffic, social media sentiment analysis, patent filings tracking, insider trading databases. Portfolio management tools like Portfolio Visualizer for backtesting, Morningstar Direct for fundamental analysis, FactSet for institutional grade research. The smart investor mindset is don't try to beat the market. Warren Buffett is right. Time in the market beats timing the market. But he doesn't say he has access to information and deals you don't have. Lesson: focus on wealth preservation and slow growth, not get-rich-quick schemes. Understand position sizing with rule of thumb. Don't invest more than 5% of portfolio in one single stock. Don't invest more than 20% in one sector. Don't invest more than 50% in one geographic region. Always keep 6 to 12 months emergency fund outside the market. Emotional discipline is also very important because dark pool operators win because they exploit human psychology like fear of missing out, loss aversion, confirmation bias, herd mentality. How to counter: have a clear plan and stick to it. Ignore daily market noise. Review portfolio monthly, not daily. Automate investing to remove emotions. Don't hope regulation will solve the problem. What will happen in the next 5 to 10 years? Expansion to crypto markets. Crypto dark pools are developing rapidly. Less regulation than traditional markets. Manipulation will be worse. AI arms race with increasingly sophisticated algorithms. Quantum computing will create unfair advantage. Retail investors will be left behind. Global integration with dark pools connecting across borders. 24/7 manipulation, regulatory arbitrage. Tokenization of traditional assets with stocks, bonds, real estate being tokenized. Dark pool manipulation extends to all asset classes. Complete financialization of economy. Final advice: remember, the stock market is a tool, not a destination. Your goal is to preserve and grow wealth to achieve financial independence, not to become a day trader. Understand cycles because markets have cycles. Dark pool manipulation also has patterns. Learn them. Build multiple income streams. Don't depend entirely on investment returns. Create businesses. Develop skills. Build real assets. Stay informed but not overwhelmed. Read, learn, but don't let information overload lead to paralysis. Most importantly, don't let anger about system unfairness prevent you from participating. The best revenge against a rigged system is to succeed despite it. The harsh reality is that while you sleep, dark pool algorithms are still operating 24/7, analyzing every tick price, every volume spike, every news sentiment to find ways to extract profit from retail investors. They don't sleep, they don't rest, they have only one purpose: maximize profit. And their main source of profit is money from the pockets of people like you and me. You might wonder why I know these things, but still advise you to participate in the market? Because that's life reality. In a world where inflation is eroding your savings 3 to 5% each year, keeping money in banks is also a way to lose money. The stock market, though rigged, is still one of the least bad ways to preserve and grow wealth long term. But you must play smart, not play with emotions. Understand clearly that every time you click buy or sell on trading apps, that information is sent to dark pools before reaching market. They have 1 to 5 milliseconds to decide whether to front run you. In a world where 1 millisecond can decide profit or loss of millions of dollars, your 100 millisecond delay is truly a century. Companies like Citadel Securities aren't just market makers. They're also massive data collectors. They know what stocks you tend to buy at what times. They know when you'll panic sell. They can even predict your trading behavior based on patterns from millions of other retail investors. This isn't science fiction. This is the reality of modern markets. Dark pool volume has increased from 15% in 2005 to 40% in 2024. This trend will continue because, simply put, it's too profitable for institutional investors. Meanwhile, retail investor volume only accounts for about 10 to 15% of total market volume, but contributes nearly 50% of profit to market makers. That's why they encourage retail investors to participate in markets through commission-free apps. Another painful truth is that even when you use professional trading platforms, you still can't escape dark pool influence, because they've become an inseparable part of market infrastructure. They're like parasites, embedded so deep in the system that removing them could collapse the entire market. But here's the most important thing you need to understand. Knowledge is power. And now you have knowledge that 99% of retail investors don't have. You know the market isn't fair. You know there are hidden forces operating. You know you need to adapt instead of complain. That's your competitive advantage. In a world where information is gold, your understanding of how dark pools work has elevated you to a higher level than the majority of retail investors. They're still blindly believing the market is fair. They're still using market orders. They're still trading based on emotions. They're still falling into traps that dark pool operators have set up. Finally, remember that dark pool is just one of many tools the house uses to maintain edge. There are many other dirty tricks like spoofing, layering, quote stuffing, wash trading, pump and dump schemes that we haven't had time to discuss fully. But the general principle remains: understand the game, play smart, think long term, and never put all your eggs in one basket. Markets will continue to evolve, technology will continue to advance, regulation will continue to lag behind innovation. What you learn today might be outdated in 5 years. But the mindset and principles I share with you will remain relevant. Because human greed and market manipulation are eternal, only forms and methods change. If this video opened your eyes about the truth behind the stock market, please share it to help awaken more people. Don't let dark pool sharks continue to silently devour retail investors. Knowledge is the only weapon we have against this rigged system. Spread it. Remember, they win when you're ignorant. You win when you're informed. The game is rigged, but it's still the only game in town. Play smart, play safe, play long term. In a world where information is power, ignorance is poverty. Don't let yourself be poor in information while they're rich in manipulation.